Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Stamos Nicholas. Stamos is a principal with Deloitte Advisory Financial Services. Stamos, we're here to talk about some new accounting rules, specifically SFAS Rule 141R, that will have far-reaching implications for mergers and acquisitions. One area that will be affected is earnouts. What will the change be there?
There'll be a substantial change in the earnout provisions of 141R to where there's, depending on the way it's structured and negotiated, it probably will be recorded as a liability on the balance sheet when it's acquired, and will have to be remeasured every quarter depending on what the expectations of that earnout. That's very different than what the current rules require.
Right. Currently, it's accounted for as the earnout is paid out. Is that right? And
yes.
Now it'll have to be accounted for in bulk right out of the gate.
In bulk out of the gate, and then continuously until the earnout is paid under the provisions. But again, it depends on how it's structured, because there are different techniques and approaches that you could take in terms of looking at how you want to structure the earnout in terms of minimizing the uncertainty.
Well, what's the real challenge for deal makers then? If they want to use an earnout in a deal, and it's a popular mechanism certainly, what's the challenge in doing this accurately under these new rules?
You'll probably need to estimate on day one when the acquisition takes place as to what the earnout liability is going to be, and therefore you probably a planning exercise in terms of what the possibilities of the earnouts will be is going to be important to know ahead of time to minimize the uncertainty later on when you have to actually record the liability. So people need to plan ahead in terms of what the scenarios could be as to what the earnout may end up being actually under what conditions are agreed on in the agreement.
Another change that comes with these rules that will have big implications for deal makers is how intangibles are accounted for on the balance sheet. And I want to narrow that a little bit and talk about in-process R&D. So when a company is acquiring another company and that target company has in-process R&D, what's the change in how that's accounted for? That's
a big change also with the new rules. Currently, the way the rules require the in-process R&D to be handled for accounting purposes to expense it immediately upon the transaction. So there's a fair value that's estimated of the in-process R&D, but that expensed through the transaction, therefore it doesn't show up on the balance sheet. The new rules are going to require that they end up on the balance sheet on day one. When you do value this in-process R&D as an asset, the asset will stay on the balance sheet until it's abandoned, and then it's going to get written off later on sometime, or once it becomes viable and it becomes a product or technology or whatever it ends up being, then a life has to be established and it gets amortized. So it has an implication long-lasting afterwards in terms of what the volatility may be on the balance sheet and the P&L in terms of what it may look like.
So deal makers really have to make some pretty fundamental decisions about in-process R&D and how it will progress before the deal is ever signed.
It would be a very good idea to do that because, again, you want to minimize the surprise that you may end up later on in terms of what it may look like financially on the statements.
So these new rules are in effect. What's your advice to deal makers who now have to face them as they work deals?
Given the breadth and depth of the new rules coming out right now under this 141R, it's probably very important for companies to plan ahead and bring in the right people involved to really analyze the transaction from multiple dimensions. So it really is not only a question of structuring, it's also what the implications are from the economics of the transaction and how it's going to be recorded, and even the tax implications are going to be important to know way ahead of time before you want to strike a deal.
So who needs to be at the table and when do they need to be there?
Usually even before you're at the table, you probably want to have the deal people obviously be there, the legal teams, the financial reporting teams, and the tax teams talking among themselves as to what is the best strategy here in terms of looking at an acquisition.
So what's the danger in not thinking earnouts through, thinking in-process R&D through early in the deal cycle?
There could be some ugly surprises in terms of what the financial statements may look like, that it may not be performing as well as they thought, and that there's a lot of transparency now with what the rules are going to require. So this is going to be something that investors are going to see as to how well that transaction fared, and if there was some planning ahead of time, you could at least appreciate what the dimensions are in terms of what that transaction may look like.
And doing that accurately up front saves face for the CEO and the CFO, who are making expectations to Wall Street based on the projections for that deal.
It could end up being that way, that's right.
Stamos Nicholas with Deloitte, thanks so much for stopping by.
And thank you for having me.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.